Zacks Rank Buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zacks Rank Buys. You're going to hear about a couple of growth and income stock picks now from Todd Bunton, our growth and income stock strategist here at Zacks.com. First one is Yum Brands, YUM the ticker. You written about this one before?
I have,
right?
yeah. I'm a big fan. They operate, well, they're one of the largest fast food restaurants in the world. They own KFC brand, Taco Bell, and Pizza Hut. And global growth story here. And really the big driver everybody's talking about is China. And there's a reason why. Same-store sales were up 19% there in 2011. The company opened 656 restaurants in China alone. So that's obviously a huge growth driver for them, both now and in the future. The company is investing a lot of money there. Results here in the U.S. have been a lot more sluggish, but they're also expanding in other emerging markets too, which is driving growth. But China's really the main story here. The company recently came off a very solid fourth quarter that was led of course by China again, but somewhat improving sales here in the U.S. and that prompted analysts to significantly raise their estimates for both 2012 and 2013. As you can see in the chart here, almost unanimously analysts raised their estimates off the quarter. And they expect strong growth from this company over the next couple years. 14% earnings per share growth this year, 14% growth next year. So good double-digit earnings growth from a big company. And also a good income story, and I think that gets overlooked. They pay a dividend that yields 1.8%, but they've increased that dividend at a double-digit rate every year going back to 2004. And the company's also buying back a lot of stock. They spent over $700 million last year buying back stock. So that should also help drive the bottom line going forward. So you've got growth, you've got income, and you get it at a reasonable price. They're trading about 19 times forward earnings. Historically, they trade around 17 times, so it is a small premium to that. But considering their growth going forward, it's certainly not unreasonable. So there's a lot to like here. All
right, the next thing you're going to tell us about is a master limited partnership. Not just a limited partnership.
Right.
Enterprise Products Partners, LP, EPD, the ticker symbol. They're in the oil and gas area.
Yeah,
right?
and they're actually a pipeline, which is one of my favorite segments. So they have over 50,000 miles of pipelines. They transport natural gas and oil, and it's a lot of fee-based income. So their revenue doesn't fluctuate with the volatile oil and natural gas prices. So very solid, steady cash flow, and they've been returning that to the unit holders, to limited partners, which I'll get to in a second. But it's actually delivered 9 consecutive positive earnings surprises, and that's prompted analysts to raise their estimates going forward. And they expect solid growth from the company to continue over the next couple years, especially because of the natural gas liquids segment. They're growing that organically. Based on consensus estimates, about 11% earnings per unit growth this year, 7% growth next year. But the real story here, I think for most investors, is the income. They pay a distribution that yields 4.9%. And as you can see on the chart here, they've steadily increased that over the last 12 years at about an 8% compound annual rate, even during the Great Recession when oil and natural gas prices were plummeting. And they've actually, if you look at it on a quarterly basis, they've increased their distribution 30 straight quarters. That's unheard of in among most dividend-paying stocks. But again, that goes back to their fee-based income, solid, stable cash flows, and they're returning that to the unit holders. They actually have to because they're a master limited partnership. If they don't, then they'll get taxed on that money. So you're getting growth, you're getting income, and you're getting it at a fair price. They trade about 21 times forward earnings. The industry average is 20 times. So it's certainly not too unreasonable there. Historically, they trade at 21 times. So I'd say a fair price for a very solid, stable company, and a lot of upside potential here.
All right. Do you own either one?
I do not.
All right. We have other stock pick ideas for your consideration and review, and those would be on our website. You can link to them right off the homepage, Zacks.com, if you're not there already watching this video. With Todd, I'm Terry Ruffalo.